I'm gonna call the meeting. I'm gonna call the meeting to order at 4:03. Let's start off with reviewing, the minutes of the last meeting. May I have a motion to accept the minutes as read?
Make a motion to accept the minutes as read.
Second the motion, all those in favor say aye.
Aye.
Second, okay. And now let's have our, folks from Rockland Trust, make their presentation.
Oh, did Hayden?
Hayden, I apologize.
Yeah, we didn't know
weren't
you
gonna
were
be here. We would've
working
sent it out.
Sorry, say that again?
Well, you know what? We can probably forward you a copy of it as we're here now. I apologize, I'm handing out, the regular packet we usually go through, and I didn't realize you're gonna be remote, or we would have sent it ahead of time, but.
I
Probably,
can probably find.
yeah, if you want me to, I'll try to bring my phone out in the meeting, but we can probably send him a copy.
Okay.
Great, like that.
Well, you know what? I'll let you do that and I'll do my piece in the meantime. And yeah, his email is on the, in the package. All right, so I'm gonna turn you to page 2. And how much time are we being allotted this evening?
You have up to a half an hour.
Up to a half an hour, okay?
Great.
We'll keep to the half an hour. Thank you. All right, so I'm gonna go through the administrative review, the quarterly reporting, and then I'll turn it over to Brian for the allocation and the performance. And then, there's some market commentary in there, more so for questions than anything else. All right, so we have, again, you've seen this information 1,000 times now. The account was opened in November of 2007. The investment objective is growth. Brian will go over that, as you know. Right now, I have the only authorized signer is Diane, so that hasn't been updated, but should I send a new form to get that updated?
Yes.
Okay. So I'll send that to you, Diane, and then we can get it updated.
And
So,
while you're at it, I'm gonna ask Julia, would you give your home address to those folks before you leave?
Sure.
In the event that you get elected,
In the event,
In the
yes,
event.
okay.
they
All right.
should replace, the information they sent to.
I will give you that information.
Okay, awesome. All right, so then will it just be Elise and yourself, Diane, will go, you be the only 2 authorized signers?
Yes.
Okay. So I'll send that out to get that updated. And again, we list the commissioners here. And no, from the information you can see, nothing's changed. So you're,
Nothing has changed. We are having an election on April 7th. and
oh,
Hayden
okay.
has chosen not to continue to run,
Oh,
so,
sorry about that. Sorry, Hayden. Okay.
What was that? Sorry, I couldn't hear that.
I said,
You're gonna be missed.
we said, sorry, you're not running again to be a commissioner.
Oh, yeah, thank you.
Yeah, so will this be, the last meeting with you?
This is it, my swan
Oh,
song.
sorry. We've gone through an awful lot of, investment and market gyration together, so you will be missed.
Thank you. I'll miss all of you.
And just to give you one, as far as goes, we were at obviously a lot of these, Hayden's insight and I would say at times almost pushback about items or discussion, has been instrumental as far as what we think as a board and portfolio construction. So continually, obviously asking questions, you all do a great job. So with you guys, but he's got a lot of, obviously, it's firm, it's just what he does, but it's been, great working with you. And as I said, a lot of towns don't have that. So you've been, enriched by having.
Thank you. Appreciate the comments.
Did you forward that to him?
I did. So
So
that
we-
should be in your email right now.
Okay, I'll take a look.
We brought you a cake, Hayden, but we're just gonna eat it.
Hey, not fair.
And then the last notation on this page is the overall fees, so based on the market value on 229, the annual fee works out to 33 basis points. All right, so the next couple of pages are, I just put this in, this is the September quarterly report. Can I expect the December information soon to get the December one updated?
Yes, hopefully.
Okay. I know you've been drinking from a fire hose, so. So again, more so just to show you the outline, and if there was any changes, this is very customizable, so if you ever wanted any changes, we could certainly do that. And then with that, I'm gonna turn it over to Brian. We're on page 6.
Yeah, so on page 6, and even, I'll say sometimes this page, seems pretty simplified in general. Or in a lot of groups that we're speaking with, we say this is actually sometimes a lot more important than things we talk about later, because we have obviously, a good bit of meat and potatoes, and have performance and et cetera. But so many people we get to, they're like, oh, let's get into those market slides and see what's going on. And we're like, well, since it's a trust, this is to perpetuity. So the things we want to make sure is we're investing it, as you handed us the funds are in line with that. So what we have here is essentially compliance reports. So there's the allocation, the type of instruments on the left, cost and market value, the percentage, and then are we in line, or are we in position to manage this? And so we keep out of, are we within policy? If there's a no there, we either, saying you have some explain and do, or it's like a cash flow happened or something like that, because a lot of times different managers will come in and you see no's and they're like, well, we went to cash because we expected the market to go down. Well, that's not the with the feeling, or should say the intent of this board, and nor has it been. It's to manage the money through time. Obviously, the thick and thin in there, but certainly we want to make sure that we're investing overall to the investment policy and what the group really adheres to. And so you won't see us going to, 95% stock or 95% anything like that. So, so as we said, a lot of people go, yeah, why do we look at that? It's because there's too many people that are always like, right, what's the Fed gonna do in June? And it's like, well, that's not why the portfolio is constructed. So, and that's why we have that page.
What is where the second to last column there where it says normal?
Yeah, so if you kind of think of a target allocation, we're essentially a 70-30 stock to bond portfolio.
Mhm.
We have a percent in cash. Way back in the day, they always used to say 5% in cash. It kind of went down to 2 in general. And when rates went to sub 1% or 0.1, we said, gee whiz, let's have enough that we can be nimble in the portfolio. We also have enough liquid securities that we can get to where we need to be. Otherwise, why have that much in cash?
So equities, just as an example, of 72%. We're at the very high end of the range, but that's expected. That's approximately kind of a.
Yeah, great point.
October.
This is as of,
So that's the investment
report was
policy.
as of September, this is as of February 29th.
This
So
report,
this is-
this report's 2/29/24.
Oh, okay.
Yeah, sorry.
Yeah, sorry.
Yeah, but
You
great
should-
point.
yeah.
And I should have said that the investment policy, we originally put it in 09, it was revised in 2020. So we're saying, are we in line with the document from 2020? But good point on the allocation, that we're saying, okay, 50 to 70, that's the general that they put as a range. 70 is actually the norm. So 72 is, I would say, more in line. Actually, it's more just stock market up.
Right, that could just
Like
be
that.
1 week's,
Yeah,
whatever.
yeah, exactly. It can change in very quickly. But to that point, though, if it keeps running, we'll say, if the market doesn't do it first, we're gonna take it back. And normally what we've looked at is when you do rebalance, a lot of times you'll go, say it was 74.8 or something like that. Like rebalancing empirically almost says go back to, say, 72 first to have it allow for run and then go back to 70, as opposed to say, take it right back in. Sometimes you lose the model, or I should say the modeling, which we've shown tends to say if you just take it right back to a lower portion, sometimes you leave a good bit in the table. But we don't want to.
In other words, you can lose out, you can destroy value by rebalancing too aggressively.
Yes, yes, you want to make sure you're aware of it in multiple instances. And I think we've had that conversation before. We want to make sure every one of those even small asset classes that we have a number in this, okay, it's only 3%. But if it goes up, emerging markets can, and they can halve or go up double, but if it goes up 50%, let's make sure that goes back. But you don't necessarily want to race back to right to the 3 or something. Well, to make sure that you allow for it to go.
Just a quick
Okay.
question,
Yeah.
if I may. So the investment policy statement, the range, is that what is in the statement?
Yeah,
Yes.
So it is specific between US equities and non-US equities?
yes.
Yes.
Okay, okay.
Yep.
That was my question, thank you.
Yeah.
Brian, it's
Yep.
Hayden. I forget, do you have specific parameters for rebalancing? Like, do you do it every quarter, or if it gets more than, say, 3% above? Or is it more kind of you're watching it and periodically, through trades of stocks or whatever, adjust.
Yeah, so overall, we used to try to almost look at it quarterly, and as I said, we did so much more research and modeling, and said, you know what, it's almost over balancing, so twice a year, we try to look in, and we actually essentially run it through the model, but and then you, if you wanna call it a qualitative overlay, okay, are these things really off? It's not just like pull the trigger and pull every stock back for the sake of trading. But as we kind of started and alluded to it, each, on the mutual fund side, those funds have how much are they gonna move? I said, 50% on all those small ones, more esoteric asset classes. The larger ones, so the core bond and core stock is essentially a 5% absolute number. If our stock went from 70, and we already know we have a hard stop at 74.95, but it went that 5%, we'd be pulling it back. Same thing on the bond. We usually keep it at, right around that 30. If that's shot to 35, and for the fixed income to move that much, it usually means that there's the opportunity on the other side, which essentially is March of 2020, right? You say, oh, wow, look how much fixed income we have. Well, it's not that, it's because the stocks were down 30%. So yeah, the two biggest part, it's an absolute number. And then the small diversifying pieces, it's more of a percentage of what they're holding.
Okay.
Yeah.
Am I reading this correctly? Currently the fixed income, we have an unrealized loss.
Yeah,
On the mutual fund, yes, across, yes. Yep, and that's left over from 2020. Essentially, the Fed went from 0 to 5%. And it's kind of think of it as a teeter-totter in school. When interest rates go up, prices go down. It's the math, and now we're gonna start accruing for it. To that point, or again.
Dave, fixed income mutual funds pay a lot of dividends and they get reinvested back in. So even if you, like, let's say you held a fixed income mutual fund for 10 years and yields didn't move, you would have made a lot of money, but you would still be at a 0 unrealized gain. You see what I mean?
Yep.
And so
Yeah.
having a unrealized loss on a fixed income mutual fund that pays a lot of dividends is not surprising.
Yeah, that's actually a great point, because that's happened across the board with funds. Some people say, well, yeah, my Pepsi stock is so much better than any of those funds you bought, Brian. It's like, oh, yeah, because the Pepsi never adjusts in cost. The mutual funds can get every, end of the year are paying us out either dividends, income, or capital gains out of the fund. So the basis starts saying, and essentially stays where it is, as Danny pointed out, and all of a sudden the market moves and you're like, wow, those are all bad bets. It's like, no, they're invested in there, they're either redeployed there or in another asset class that needs to. So we need more asset allocation, because that is, as I said, the asset allocation is much more important than any market thing that I would talk about, as much as us investment people always love to get on stage and talk about market stuff. It's more, the construction and allocation of the assets. Here's another, the map of on page 7 is the performance. You can see essentially the value as of last month end. Again, the percentage of portfolio, and what we have here is, the performance has grown across different segments of time. It's, the general ones, 1, 3, 5 years. Net of fees, these seems to be need and benchmark, outlined below. It's the investment policy statement, or the benchmark stated in that. And then we have the bond portion, and then the equity portion, and so they said there's been kind of breakouts between there. Let's see, overall, if you look at the long-term numbers, the bond portion is held up.
you're gonna speak up, so that.
Oh, yeah.
Hey, we can do more.
Sorry about that. So you can see the breakouts across the board. And then, obviously, benchmark, and it's in, certain time frames. Yeah, it's a great 1 year, okay, and then, in 3, and then you start going into, as I said, each period it's almost like if you look at the annuals, how do they look at, and that's why we do put behind there a lot deeper analysis on the page behind. But if you think, when you talk about just performance overall, we'll never jump around or dance around. If there's a cake, we dance around it, but we don't dance around for a portfolio for short-term performance. We know because it changes too quickly. We didn't hang our heads in 08, I mean, sorry, yeah, or 2020 when the markets were down dramatically. Two reasons. One, we knew they would come back. The other part is, you know, the portfolio or your trust outperformed dramatically over that time period. So when 2023 happens, and we're not gonna try to chase every spec of the NVIDIA and, you know, and AI run up. So the same thing, we don't hang our heads when that comes back. And we didn't share in 2022 with more sign of relief. Hey, that was great that we saved on performance on that side. And so when you look at it, you know, when you look at that, and what I'm really alluding to is that 1 year number. Great to have it, really helps, gives us a tailwind, when you earn, you know, 16% overall. The hard part about that, you say, well, the only way you're really going from there is down. Because the average returns just don't indicate that we would have that kind of return through time. From this, and will be interesting, we used to state that with this kind of allocation, it probably should have been about 1% higher than where we are. And that's probably what we stated when we were here in 09 and in 08 kind of establishing these. And then interest rates went to zero for a decade. So if you think of how you get to your, you know, 7, 8, 9, you know, your turns through portfolios, if stocks earn 10% through time, over the last 70 years, was over what, 10.5% over 70, 80 years. Bonds used to return 5 to 5.5 to 6.5% over that same time period. Well, when interest rates go to zero, that means, you know, and then persist for a decade. Then when your yield's at 1.5, just do the math on this 30% at 1.5 instead of 6 and 70% at 10. Okay, now we know that we know how you don't get there. The other part is we do believe, and I think it's correct, you want to diversify the portfolio. There's some charts in here behind it. Diversification did work in 2020 to help against a declining stock market. But overall, the last decade, large cap stocks have really ruled the roost. And who would think that the largest companies in the world would do the best for a full decade? Prior to that, though, if you look at the first decade in this century, it was essentially negative returns for the S&P. So you had to be diversified or you were in trouble. So again, so the diversification hasn't added as much as we'd like to that 6.17, along with fixed income yields, as you see below, essentially being, you have a 2 handle, a 2.34 and 2.63 over since inception. So certainly, you know, when you say inception 12/1/07, you can almost hear it ticking when the money came in, right? with 08 looming. But the stock market has done its job, or I should say the equity portion, since we started the individual equities, almost that 10% that I spoke of, 984, benchmark equity 761 in the time frame. So it's done the job. It's been that diversification, right? It's been everything else that we put in the equity funds, international, et cetera, just haven't kept up. Obviously a lot of reasons which I'm happy to go into with it, but you think of coming out of 08, the probably was gonna run really hard coming out of 08. I'm like, well, real estate got, you know, got appropriately, you know, hit in 08, and emerging markets, international, those things, I think they should come back. Emerging markets, if you think of the largest markets at that time to come back, well, it was China. Think of all the undulations on the markets they've had. Brazil, political issues with, you know, people going to jail for it, forcing, you know, Petrobras to dig in the wrong spot when they didn't want to. All those type of meddling in the markets. India and Russia. India hasn't been able to get its own way, and we know what Russia's been doing. So the emerging market didn't flourish like we did. We think of emerging markets, you think of everyone who wants to be more US centric or grow at the same rates, I should say rates higher than domestic, and it's than developed nations should. Developed nations should be mature and grow slower. Emerging markets should grow faster. They haven't done that over the last decade the same way because of these fits and starts. So, and then same thing, international, if Europe didn't recover with us because Greece tried to leave the euro, then they had Syria blow up and the migrants come in, Greece tried to do it again, Russia took Crimea, now Russia tried to take the rest of the country, so they've had a lot of issues as well, geopolitical items that we just think that hopefully getting behind them in international markets should at some point contribute more as well. So we're not giving up on diversification, and as with your IP issue, haven't either. It's just a matter of, we'd like it to be giving more to the portfolio.
Brian, on my swan song, I'm gonna throw out a compliment here. I think these are good results, maybe very good results, given your comments about the magnificent, well, you didn't say Magnificent Seven, I don't think, but where the market's been driven to a large extent in recent years by the Magnificent Seven, last year certainly, and in general by similar kind of large growth stocks. Most active managers, which you guys are, at least in the large US space, have lagged behind because of that. And so I think the fact that you've been able to be around or ahead of benchmark 1, 3, 5 years during a time when it's been very challenging for any kind of active management, I think speaks well.
Thank you. Thank you.
I agree.
Yeah, it's, and we'll see how that continues. We will invest, we're not anti, the Magnificent Seven, or whatever, a lot of the acronyms we put out there, but we wanna invest in the ones that make fundamental sense. If we purchased Apple, or we've done Meta when it was, cheaper and it's run up, so we've had successes there. At the same time, we'll admit we missed, NVIDIA. At the same time, we haven't, looking at it, hasn't made fundamental sense to do it. Haven't done Tesla and gone with the undulations of it, but like, so, we wanna be in companies that we think can contribute on the AI scale, but not just because it feels like someone woke up January 1st of 2023 and said AI, and people thought it was a new thing. And I say that in jest, if I said the word, hey, does anyone want to go to the Bahamas? If I said about 6 times, we'd all leave here and would have an invitation, to get away to the Bahamas on our phones. The AI has been here for a while. It's not just a new flashlight on it, but it's going to continue. Does it become something like the internet and that big and strong? We'll see. There's gonna be winners and losers. We don't know if the companies that are benefiting the most now are gonna be those winners. So we wanna make sure we're involved, but not necessarily putting the portfolio's neck, proverbial neck out into these companies that don't make sense fundamentally.
Can I address one thing you said about
Yes.
continuing to address in international markets for diversification's sake, even though there have been so many geopolitical issues? So at some point, do you reach a point where if you're investing in Russell 3000 companies, the biggest US companies, those companies are maybe better able to work around those geopolitical issues in the rest of the world and choose to invest there and do business there when it makes sense, and with a little more quickness and insight than maybe an international index fund could offer? In other words, in the name of diversification, are we really just kind of holding an index product that doesn't necessarily make sense if we have US companies who can do it better?
Yeah, and we generally want to be active in those areas, so we can have someone trying to pick the appropriate countries and sectors, et cetera, to be in. So we do, yeah, because
But we're not indexing in the international.
No, yeah, we do. We generally don't, because of the fact, for that reason, we think that I don't want to own the index in some of these international areas, because when they go down, I don't want to go down as much as the index. I'd like to somebody picking in, and they're, take nothing again, everyone's benchmark focused. So it's not like they're out just saying, oh, we're just gonna do, we think best. They are focused on it, but at the same time.
Okay, so these, where it says international equity funds, those are more active funds.
Yep.
And they have done a pretty good job relative to their benchmark, even though it hasn't contributed much overall to our return.
Yes. And behind that page is the, and I'm sorry, I don't want to treat it lightly, and any questions on the performance? On the next page, is the deep dive, if you will, on analytics or the annual. You can see all the annual numbers that way. We're happy to talk about any of those at any time to follow up, but it's really essentially saying that the top line numbers are on the first page. Behind that, they're there. And, you know, the thing I would, well, which you wanna point out really, if there is one, is that, the portfolio generally has less risk than the, benchmark overall, creates a positive alpha. You're taking less risk and getting a similar like return over time. And certainly over the last, since we've had the benchmark change even, ahead of the benchmark and having less risk. That's certainly what we're trying to do. So as far as the 25-minute range, et cetera, that's the portfolio. I have slides in there. But I'm happy to talk about anything there are. Look at that, like 14 and 15 is where we've done how the diversification hasn't worked as well because of the large cap stocks. Have really ruled the roost. But I'm happy to talk about any of the slides overall, or if you wanna have more questions or want me to stop, then I'm happy to do too. Well, my slides, but I don't wanna force them on you.
No, it's good.
Brian, I have a question on fixed income.
Sure.
Do you, I don't know if you are taking a position in terms of interest rate direction. And if so, what is it? Or are you pretty much benchmark neutral as it relates to that?
Yeah, so, I think at page 17, after this on the more markets and not, we're trying to be a lot more neutral. And to the conversations that we had over time, given that we were for like the credit index overall and the tips, we were probably a little short for a long period of time. And I think we trailed a little bit for it. We had our correction. And we had, we kind of just one time and said, how much you want me to put you on? Because, we don't want the horse to be out of the barn, but with the correction in interest rates, we're probably trying to get a lot with where my goal most through time is I like to be about 90% of the benchmark. Because what happens there is if you can be benchmark and try to get an income advantage, and if nothing happens with interest rates, you get that little win with the income advantage. If rates go down, then you participate in the bond market, you hope you can do something, a few better with credits and you can either participate, or if you lose a little on the best bond market, we're okay if we participate, and then on the other side, if rates spike, then you're gonna do a little better. We were a little shorter than that 90%, so we're trying to reel that in, we essentially have, more recently. And to your point, I do like where the bond market is right now. And that's what I'm talking about on page 17, because if you look on that right-hand side where you see the blue bars, those gray bars on the other side of it used to jet out almost like the blue ones prior to 2022. It was essentially saying if we have a surprise move by the Fed or for interest rates up or down, you're either gonna have this large negative return or positive. Well, after the Fed moves 5%, and we got really, the markets took it on the chin, again, the portfolio did a lot better. I would say this, the structure we had, and we were shorter. Performed quite well. And you look where fixed income is now, so all right, if the Fed does nothing, we'll clip our 5 to 6%, or at least 4 to 6, depending on where you're on the curve. And that's great, because we haven't had that for a long time. If the Fed unexpectedly, and that's what this chart says, if the Fed, because it's only unexpected because everything else is allegedly priced in. So if the Fed moves and says, hey, we're not done with inflation, we have to move, you can see what happens. Those gray bars, not too negative, really only the 30-year gets hit and you're not heavy in that spot, but the 30 is so long. So that means we would have lower returns, fixed income returns, but albeit, positive, albeit lower. And we're happy. I mean, then the third scenario is if they have to say, okay, we're gonna lower rates a little to a lot, then we're gonna start getting some of those returns back that essentially gave away a little bit in 2022 of great bond returns. I'll be one of the few people crying because then rates will be low again. And so I would, love that the Fed push it down, slide it down, rather than have to ratchet down. That's what they're trying to do with this whole higher for longer. We'll see how they maneuver it. I just would really like not to go back to, a yield curve that goes from 0 to 1.5 again. The old 3 to 4% interest rate curve would be healthy for all, low enough to still borrow, high enough to be able to save.
Your, page 20 slide, the market is anticipating exactly what you said, is that the rates are gonna drop faster than what, the Feds are assuming.
Yes, and the market has been pushing in hard on that. The Fed has warned off, and it's been very kind of, and I use this term, I mean, a technical term, sneakily, but essentially the interest rates went up about 0.5% from December to the end of February. Everyone's saying, hey, we're pushing for lower. Well, that's been the pushback from the Fed saying, we want this higher for longer. Let's keep this. And because the Fed is an interesting spot, because their job is essentially to be cheerleader for the markets. It's really hard to be cheerleader for the markets and say, what we're doing now is keeping rates higher and making people lose their jobs, making, making it more economically difficult. So we slow things down. They can't really say that. Like, how do they say, hey, we need a bunch of, our unemployment rate is below 3 and it averages 6 through time. Say even now with technology, it should be 4.5 and 5. We're still, no matter how you slice it.
Is their job really to be a cheerleader for markets?
Yeah.
The economy.
Yeah.
Yes, the Fed's, their job is to keep the US economy, if you wanna call it floating or as a ship in the right direction and not, and not steering astray. Too early to.
An important distinction, markets and economy.
Yeah, thank you. Yeah, they have stated before, we don't care about your markets as long as they're orderly, right? I think I'm almost the terms that they translated when they were lifting rates, especially in the spring. They said, we want the stock market to go down. It can go down fairly dramatically. It had run high, but as long as it's orderly, meaning you don't have a lot of panic days in a row. You don't want post-pop being not passed, right? Like that's an ugly day. But yeah, you're great. Thank you for that, because it's a very clear distinction. There are times they are darn set to try to make the markets go down. So I apologize for saying that wrong. They need the economy to run straight, and they need markets just to be orderly, but they can decline dramatically. In fact, I bet you they were pretty happy about what they did in 2022. They took tech back to kind of somewhat fundamental pricing, without disturbing the breadth of market.
Okay.
Questions, comments? Anyone? Thank you for all the questions. I appreciate them. And,
I need your,
Right here.
perfect, is your email address
Yeah,
on there as well?
all that.
Awesome. Thank you. Well, I wish you luck and hope you, win.
yes. Yeah.
And again, Hayden, it's been
Thank
great
you.
working with you over the years, so you've done, we will miss seeing you.
Yeah, but
Thank you.
Chairman, you have
Same.
been a good steward of the town's funds.
Thank you. I'd like to think so, so I appreciate it.
Fortunately, he just works across the street.
Yeah.
Keep them on the line, you'll see some champagne corks shoot across. No. Thank you. You're fit and well replaced as yourself and.
Good to see you, thank you. Yes, maybe. Thank you. All right, well, thank you, everyone. It was nice seeing you, Diane. Nice to see you in person. I hadn't met you before, so that was awesome.
It's been a while, yeah.
All right,
There.
thank you so much, and good luck again.
Bye-bye.
Sir.
Thanks, yeah.
Welcome aboard.
Thank you. Thank you. You're doing this. Wow, welcome aboard. Thank you, everyone.
Yeah,
Bye-bye.
we have a few,
I don't know if they picked up
Invoices
on
to go
sarcasm
through,
about the election or not.
I don't care.
got a few invoices to go through, so let's do that this time and do that upside down.
How often do they circulate statements to the commissioners?
Oh,
Monthly.
you get a statement
Month
every
is
month,
monthly? Okay.
and then.
Yeah. We need to replace, well, assuming you win the election, we need to replace you with me on the distribution.
Yeah, I gave them all my contact information, Hayden, so hopefully,
Hopefully
they'll
do that.
do what needs to be done.
Yep.
But you're irreplaceable.
Oh,
So,
thank you.
understanding,
Appreciate
so.
Thanks. But the statement doesn't really discuss, it doesn't show performance is my recollection. It's more just like a statement of assets and transactions. In terms of performance, it's just when they present to us.
There were just two, right?
I think there were three.
Yeah.
Just another question while they're doing that business. Where is the investment policy statement made available?
We'll have Hayden send that to you before before he leaves.
Okay,
Okay, Hayden?
Yeah, can you give me your email?
sure.
What I'll do is I'll send her an email with your email, and then she can send you a note.
Okay,
Thank you.
You know, announce the word.
Right.
Well,
No, it broadcast and push that. We all get a nice stamp.
Our next duty is to choose a date for the next meeting. And we have to make it after the 9th of April. So your schedule is most important in this.
April 25th, Thursday.
April 25th is a Thursday. Does 4 PM work for you?
Yeah.
Okay.
Elise, does April 25th work for you?
Yes, it does. My apologies for not being there as well. I look forward to meeting everyone in person.
So April 25th works for you, Elise?
Yes.
Okay. All right, before I look for a,
Did that work for you?
It does. If it could be like, well, I have another meeting that ends precisely at 4. I left that a few minutes early today. So I think I can pull off the same thing.
we can do it at 4.
I don't mind starting later at 4:30 or even
Is
5.
4:15 okay? I mean, that's, even that amount would make a difference for me.
Sure.
No, we'll do 4:15.
Okay.
Before I accept the,
actually, Joe, one more thing, since I think I'm doing the minutes. I usually list kind of what the invoices were about, but I didn't sign them or see them. So can someone just give me a quick rundown on?
there are 3 invoices, 2 were for the library. And 1 was for the athletic, what was that one for? The athletic,
The sports endowment
for the sports endowment.
Okay,
for Atlantic Sportswear.
okay. Thank you.
Before I request a motion to adjourn, I would like to make a statement. We, the commissioners, myself and Dan Burns, would like to formally acknowledge that this will be Hayden Traub's last meeting as a commissioner of trust funds. Hayden joined the commission 15 years ago and has served as secretary for most of his tenure. We appreciate and joke about the timeliness with which Hayden prepares the minutes. They are often in our inboxes before we get home. As secretary, Hayden has also done an outstanding job preparing a report about the trust funds for inclusion in the town's annual report. Hayden has applied the depth and breadth of his investment acumen to his position, holding our investment manager accountable by asking tough questions. He has also been an advocate for ensuring that the fees we pay our investment manager and the fees on our manager's investment selections are appropriate. Finally, Hayden's advocacy helped maintain the Commissioner of Trust Funds as an elected officials rather than appointed. We thank Hayden for his dedication and important service to the town, and we wish him well.
Joe, thank you. I've loved working with you. Enjoyed working with all of you really. And it's kind of sorry to be done, but just it's time. So anyway, I appreciate all the nice comments.
And I will, I'll forward you the text of what Joe just read, because Joe wishes for it to be included verbatim in the minutes.
That's very nice. Thank you.
Congratulations, Hayden.
Yeah.
Thanks a lot for everything.
Thanks. Appreciate it.
Before you adjourn, I don't know if this falls under the topics not reasonably anticipated.
It does.
Okay, this just arrived, about an hour and a half ago, so I don't know if you wanna take a look at that and have it as a little homework.
To the Commissioners of Trust Funds. Are there any trust funds that could pay for decorating electrical utility boxes around town? Paul Good of Needham Revitalization Trust Fund estimates $1,400 per box for shrink wrap method that withstands weathering. Respectfully, Patricia Falco, a former commissioner. I don't know this. The only one I know that can do that would be
Doing the bulk.
Paul
Yes.
Good, and I will inquire to Paul Good before our next meeting and come back to all of you with the answers. Okay. I'll entertain a motion to adjourn.
I actually did have one question for Hayden before we adjourn, sorry.
Yes, that's all right.
And maybe it's actually a question for Diane and for Dave. So where do the minutes of our meetings live? I know you type them up, you send us a link to a Google Doc. Do you archive those in some way?
I believe, go ahead, Hayden. Go
So,
ahead, Hayden.
so they're on my computer. I have a directory that has all the minutes since I've been doing the minutes. There were times where I wasn't the one doing them. So I can make those available, but I'm guessing there's also some record of them at town hall somewhere.
Be with the treasurer, but what I was going to suggest, because many committees are doing that, is we can upload them into the webpage where the trust commissioners have a site, so they are there for.
Yeah, it just seems, I mean, we should do that, and at a minimum, if Hayden is no longer a commissioner, someone at a minimum should hold on to them, but yeah, they seem like they should be public.
So we can arrange.
So
for
if it's
that.
in a Google folder, Hayden, why don't you just send us a link to it, and then we can take it from there?
Yeah, unfortunately, it's not in a Google folder. It's just in a,
Or whatever it is, just send it to us however it makes sense.
okay.
And one final comment, Hayden, do you have any of the trust document books? You know the
Yes,
books? Yes.
yes.
You have until our next meeting to get them over here.
Okay,
And you can either bring them to the treasurer's office if that's convenient, or wait for our next meeting and hand them personally to our new commissioner, whoever that may be.
I'm
Yeah,
about
not-
2/3 of the way now through naming all of the PDF files that I scanned. So we're slowly getting there.
We're getting there.
Yeah.
Yeah.
I will likely plan to bring them to the treasurer's office if that works.
Okay, thank you.
You know where to find us.
Yes.
All right, motion to adjourn.
All those in favor say aye.
Aye.
The ayes have it. We'll see you all next month.